Hello, and welcome to the latest budget briefing from Finsbridge Financial Planning. In what has been the most consequential budget in a decade, then there has been some seismic changes that will affect us all. To help make sense of it, we have with us today Mr. Rohit Rohela, Managing Director at Finsbridge Financial Planning. Hi, Rohit. Welcome to this podcast.
Hello, Gaurav, and thank you.
So Rohit, as we were saying that this has been one of the most awaited budgets,
Indeed.
and there have been some major changes. Were you able to get any sleep last couple of nights?
Good question. What do my eyes tell you? Not really, but I've spent my time very fruitfully looking at all the changes, analyzing what impact it has on our clients. So it's been good.
Great. No, absolutely. Our clients are very keen to understand from that we've been getting constant emails and calls, and so let's dive right in. So, Rohit, perhaps we can start with the understanding of some of the key announcements that are relevant to our clients' financial planning needs. For each area, if you could highlight what was in the older regime, what has changed, or maybe what has not changed, and how does it impact clients? And for all our podcast viewers, just a quick note: we will be sending a short briefing on this to all our subscribers separately as a follow-up. Rohit.
Absolutely. Right. So let's break down. There's been lots of different changes. Let's break down the key changes that have a direct impact on our listeners who are primarily private clients and business owners. So starting with pensions, that's the most crucial area. So the big change that has happened in pensions is that they used to be inheritance tax exempt. Okay. Now they are considered part of your estate, or they will be considered part of your estate for inheritance tax planning purposes. This is supposed to start from April 2027, so there's a little while to go. But it's probably the most significant change to pensions since pension freedoms itself. So effectively, now if you are over your bands, then you have a potential problem, and that includes your pension. So the nil rate band, which is 325,000, Gaurav, and then if you're passing down your main home to your children, you get an additional 175,000 called the residence nil rate band. So for a single person passing down their property to their children or estate to their children, they've got 500,000. If it's a married couple, then on first death, the allowance passes to the surviving spouse. So altogether, it's around £1 million. So in the old regime, this £1 million would not include the pension. Okay. Now, what's measured against that 1 million? It includes the pension, and therefore, if your assets are over that limit, then you have a potential inheritance tax problem. So it's really important to be aware of it and to seek advice where necessary. Okay, so that's been, if you like, a worse change, but there have been some good outcomes on pensions as well. So a lot of things were expected to change, but they didn't. So, for example, you still get the higher rate and basic rate tax relief. So, if you're a basic rate taxpayer, for every £100 you put into the pension, you get another £25 added by the government. If you're a high rate taxpayer, for every £100 you get another £50 put by the government, and even more if you're an additional rate taxpayer. So there were rumors, they were tinkered with that. That hasn't happened, and it's probably not going to change for at least for the next 5 years. So that's a good thing. Lifetime allowance, so that's the amount you could put into a pension throughout your lifetime without paying tax. That was abolished. That's still the case, so you can still build a pension fund. Of course, the lump sum, tax-free lump sum you can get is still 25% up to 1,073,000, which is the which used to be the lifetime allowance. Now it's the lump sum allowance, so that still continues to be the same. So pensions are a great vehicle for investing for your retirement. What has changed is you can't use them to pass on your wealth to your children or to the future generations, which was not really a purpose for pensions in the first place. So if you're affected, then the key thing is to seek advice and to make sure that your planning is updated accordingly.
Indeed, indeed. I think advice is relevant here because these are major changes. And as you rightly said, the good part is that the annual allowance stays The LTA is not being reinstated, so these are good things. Thanks, Rohit. Thanks for covering that. Can you also cover what's the change that has come into capital gain tax?
That's another significant change. So the government promised us, or Labour Party promised us, that they will not be making changes to the major rates of tax: income tax, national insurance, VAT. Okay, so what was left was inheritance tax and capital gains tax. So we've touched upon inheritance tax a little bit. What's changed to capital gains tax? Let's cover that. Okay, so capital gains tax on property stays the same. It was feared that they would increase it in line with income tax rates. Hasn't happened. So if you're selling a rental property or a second home, you still pay 18% if you're a basic rate taxpayer. And if your gain takes you into the higher rate or additional rate, you pay 24%. So that stays the same. But the capital gains tax you pay on sale of shares used to be 10% basic rate, 20% for a portion falling to the higher or additional rate. That's now changed to 18% basic and 24% higher rate. So you are going to pay more capital gains tax when you sell shares. Also, if you are a business owner, very relevant, on the first £1 million per person, you got entrepreneurs relief. So this is called business asset disposal relief, where on the first million you paid tax only at 10%, and then on the excess you paid tax at 20%. So what they've done now is from the tax year 2025-26, the next tax year, they're going to increase this 10% for the first million to 14%. And then from the tax year after that, and for the future after that, it's going to be 18%, okay, on the first million. So that's a significant change. And after that, of course, it goes to your regular sort of rate of 24% from next year. So if you are a business owner who was probably thinking of exiting or selling in the next few months anyway, then it may be a reason for you to think about doing this in the current tax year, so before April 25. So the key message is, if you're looking to sell your business, or if you have a property portfolio, for example, you really need to be seeking advice. Maybe there are better ways, more efficient ways of investing. And there are investments called enterprise investment schemes, which can help you reclaim capital gains tax. So again, talk to us about those and see what you can do to stay ahead of the game.
Right, right. Uh, while you're on the subject of businesses, the other change that we are hearing is going to affect businesses is related to the employer national insurance. That obviously is bringing up some bit of their cost, right? So it is impacting businesses. Can you throw some light on that? Can you expand on that, please?
Absolutely. So as I pointed out earlier, tax on individuals, they promised they're not going to raise. So businesses were going to be the next target. Okay. So in the earlier regime, you had employers' national insurance that was paid above your employee's salary being over a certain secondary threshold. It's called the secondary threshold, which used to be £9,100. So what they're going to do is they're going to reduce it to 5,000, okay, and they're going to increase the rate at which employers pay this from 13.8% to 15%. So that's a 1.2% increase. So it's a double whammy. Uh, but there is some good news there for small businesses that have less than 4 employees. Okay, so they've added something called an employment allowance. So if you have more than 1 employee, okay, and less than 4, less than or equal to 4, then you get an allowance of 10,500. So in a way that negates the effect of this increase. But
Right.
if you've got more than 4 employees, then you're going to be on average £675 approximately worse off. So this is going to have an adverse impact on wage increases, on businesses' ability to employ people. So again, if you are affected by this, then it's very important to seek advice. There are lots and lots of ways and strategies to reduce your tax impact. So pension contributions to extract capital. If you put pension contributions through your company, then they act as an expense, reduce your corporation tax burden. You can also extract capital and use venture capital trusts to reduce the personal income tax on it. So again, speak to us. There are lots of ways we can help you.
Right, right. Uh, so thanks for that, Rohit. So now let's move on to the tax that we all love to hate, the death duty and the inheritance tax. It is a tax on wealth which is already taxed, right? So when it passes down after death, uh, there is obviously a very high percentage that is applied to the already taxed amount. What has changed with the reliefs around it?
Yeah. So before we go into this, Gaurav, I share your passion in my hatred for this tax. Okay. And therefore, I take a lot of pride in helping our clients plan to avoid paying this, not by doing anything dodgy, but by using allowances which the government gives us. So these are called reliefs and they have changed. Okay, so there used to be assets such as agricultural assets and business assets, trading businesses, which were exempt from inheritance tax, and there was no upward limit to it. So these were typically unquoted businesses or AIM. AIM is alternative investment market listed businesses. So if you had shares in these businesses, then and you had held them for 2 years or longer, you effectively paid no inheritance tax. The principle still continues, but they have introduced a limit to it. Okay, so let's understand first what has happened to agricultural property and unquoted business shares. So what has happened there is that they've capped the relief to £1 million effectively per person. Okay, so we still have to see whether business relief qualifying assets that pass from husband to wife or wife to husband between spouses, do they effectively double up? We still have to get an answer to that question. But effectively, any business relief assets you hold over the 1 million threshold are now subject to a reduced inheritance tax rate of 20%. Okay, so the relief has been effectively reduced by 50%. So that's a significant change. If you have agricultural land or if you have businesses which you think are valued over that amount, then definitely planning needs to be done around that to prevent catastrophic consequences. Also, AIM shares we talked about, alternative investment market. So they used to be inheritance tax free. They are going to be subject to inheritance tax now at a reduced rate of 20%. And there is no, I emphasize, there is no allowance at all. So whereas for unquoted business relief, which is asset backed, or for agricultural assets, you have the 1 million threshold. For AIM shares, there is no threshold. Any AIM share portfolios you have will be subject to a 20% tax. So again, depending on your circumstances, if you hold these, then it may be an idea to reach out, seek advice, and to take action to deal with this change. Okay.
Th- thanks, Rohit. Thanks. Rohit, we are now coming to almost the end of the session, but there is one more change which is significant for both individuals and businesses. There are changes around stamp duty on second property. Can you run us through those changes, please?
Sure. So a lot of our clients historically have seen property as a attractive place to invest, and for the right reasons. Property prices increasing over time, rental values increasing over time. But now, with all the other adverse changes we've seen, this latest change is a good cause to rethink the strategy. And what has happened is, if you go and buy a second home, so a home other than your main property, whether it's a holiday home or a rental property, you paid a surcharge of 3%. Okay, that surcharge has now gone up to 5% if you are an individual. If you are a company, so a lot of our landlord clients, to escape this, to circumvent the allowances you had for, like, if you were paying interest on a mortgage as an individual, you can only claim basic rate tax relief. But if you had that asset in a company, you could claim the full interest as an expense, right? So that's why a lot of people have set up companies to buy property. So if rental property that you're buying through a company is now over 500,000, the surcharge, wait for it, 17%. Okay, so with all the other changes, you need a property to be EPC rated C or above. You can't evict tenants, Section 21 abolished. You really have to ask yourself the question: is property still the right asset for me to continue to hold assets in? It may be, but if you want to review this and to assess whether there are other places which might be more suitable, remember pensions, you don't pay any tax on the growth. ISAs, you don't pay any tax on the growth. ISAs income is tax free. Pensions, 25% tax free cash. So potentially high returns, investing in the great companies of the world, which we like to speak about. So seek advice and assess whether it continues to be the right thing for you.
Right, right. Thank you, Rohit. Uh, so Rohit, now that we have gone through the key changes, can you, in your concluding remarks, give some action points to focus on for clients? What are things that they need to now look at, more importantly, because of the budget changes?
Good question. So I call these advice red flags. Okay, so they should sit up. They should cause you to sit up and take notice and start thinking. Okay, so where you have been investing in a pension, either partly or fully, with the view that okay, I'm going to pass it to my children, you really need to take advice because it may well be that it's no longer good for that purpose. So you have to then consider other things like taking out tax-free cash or taking income beyond your requirements and using what is called a normal gifting out of expenditure. So if you're drawing additional income, you could use it for gifting. You could use it to buy whole of life policies, which can mitigate your inheritance tax. So these things we are still working on, talking to our tax experts in house and externally. But the key message is seek advice. Don't sit without taking advice on this. You should review your death benefit nominations, which is a very important theme. So if you have nominated anybody other than your spouse, then inheritance tax will be an issue. If you are passing on your pension to your spouse, then there is no inheritance tax between spouses. So that may well be the better thing to do, okay, depending on your situation. If you are holding agricultural land or property, or you have a business that you think may be valued over the 1 million mark, okay, then obviously seek advice because your tax burden may well be going up. If you recruit more than 5 people in your business, 4 people, then it's likely that the employer's national insurance increase will affect you. Again, talking about other strategies to mitigate tax will be essential. And lastly, if you are one of those that is sworn by brick and mortar property investments, it's probably the right time to seek out advice on alternatives. Okay, so that would be the key message from me.
Wow, wow. So your job is clearly cut out, and there's a lot to do. Thank you, Rohit. Thanks for your time. Thank you for everyone who's been listening. We're always here to help and support you. So if you wish to have a discussion, reach out to us on connect@finsbridge.co.uk, or you can also call us on 0330 390 5006. You can also visit our website and book a consultation via the link on the top. So that's all for today. All the best and see you in the next session.
Thank you. And the website for our listeners is allthews.fins, F-I-N-S, fins, B-R-I-D-G-E, finsbridge.co.uk. So when you visit that website, on the top you will see a link in red called Book a Consultation. It allows you to choose a time in the diary that's good for you. And we don't bite, we love to talk. The first meeting, the first consultation is always complimentary. So come speak to us and we'll help you make sense of the budget. At the very least, you will go away with some actionable insights. And you never know, some of our solutions may help you make the most of changes that happen. Thank you, Gaurav, and see you next time.
See you. Thanks.